Welcome to the CFA Level I presentation on non-current liabilities. Long-term liability. So a long-term liability represents a probable sacrifice of economic benefits over a future period, generally greater than 1 year. Common types of long-term liabilities reported in financial statements are bonds payable, long-term notes payable, finance leases, and pension liabilities. Let's first talk about a bond. So a bond is a contractual promise between a borrower, also called the bond issuer, and a lender, who's the bond holder, also called the investor, that obligates the bond issuer to make payments to the bond holder over the term of the bond. In the contract, two types of payments are involved: periodic interest payments and a repayment of principal at maturity. How often interest payments are made is also stated in the bond agreement. Some basic bond terminology. The face value is the amount of the principal that will be paid to the shareholder at maturity. This is also known as the maturity value or the par value. It is used to calculate coupon payments. The coupon rate is the interest rate stated in the bond that is used to calculate coupon payments. It is normally fixed over the term of the bond. The coupon payments are the periodic interest payments to the bondholders, and it is calculated by multiplying the coupon rate with the face value. The market rate of interest is the rate of return required by bondholders and depends on bond risk, and this can change over the bond's life. So now let's just try to understand this through a simple example. So effectively, you can think of a bond as a piece of paper or this bond contract. So there are several pieces of information in the bond contract, but the most important pieces of information are the following. So a face value, let's say that the face value of this bond is 100, and as we just said, this is the amount that is due at the end of the contract. There will be a coupon rate. Let's say that the coupon rate is 10%, and let's say that this is a semi-annual bond, and you will have a issue date. Let's say that the issue date is equal to 1st Jan 2010, and a maturity date which let's say is 31st December 2012. So this is a 3-year bond, face value 100, coupon rate 10%. There will be several other terms and conditions on the bond, and this is overall referred to as the bond indenture. These are the covenants in the bond, but we will at this point worry about the core information that is shown over here. Now, if I as a company issue this bond, then this bond for me is a liability. And what this reading is focused on is from the perspective of a company that issues a bond, and also fundamentally we are concerned with how bond related information is recorded in our financial statements. Later on, when we do fixed income securities, then we will look at bonds from the perspective of investment, but now it's from the perspective of a liability. Now, when a company issues a bond and this information is given, what the company is promising is a certain cash flow. So this information basically says that over the next 3 years, so 0 and then 0.5 and then 1 year, 1.5 and so on, all the way up to 3 years. So the cash flow being promised, when we say 10% semi-annual, that means that every 6 months the company is going to pay 5% of the face value. 5% of 100 is $5. So every 6 months the company is going to pay $5, and this will go on till the end. Face value of 100 means that the company will pay 100 at the end of the so on maturity date. So essentially, as I said before, this information defines the cash flow that the company is promising. Now, what is the issue price? So issue price refers to how much money does the company raise, or how much money do investors give the company when they issue this bond. That is determined based on the market rate at time of issue. So this means that at the time of issue, investors determine what is a suitable interest rate that they expect or that they require from this company. And as we will elaborate in more detail over the next few slides, if the market rate that investors deem appropriate for this issuer is equal to the coupon rate, then the bond is issued at par, which means that the issue price 100 will be equal to par value. And if the required rate of return that investors demand, so that's called the market rate at the time of issue, is more than the coupon rate, this is saying that investors want a rate higher than the coupon rate of 10%, which means that investors view this company that is issuing the bond as somewhat risky, and to be convinced to lend money to this company, they want a rate more than 10%. So if the required rate or the market rate for this bond or this issuer is more than 10%, then the issue price will be less than 100. If the market rate is less than the coupon rate, then the issue price will be more than 100. And we will see examples of this over the next few slides. So some more bond terminology. The balance sheet liability of a bond is equal to the present value of the remaining cash flows, which is the coupon payments and face value, discounted at the market rate of interest at issuance. So what happens to the market rate of interest after issuance does not impact what we put on the balance sheet. At maturity, the liability will equal the face value of the bond. The value of the bond, which is reported in our financial statements, is also known as the book value or carrying value. The interest expense is reported in the income statement and is calculated based on this formula, which is bond liability at the beginning of the period multiplied by the market rate of interest when the bond was issued. So this is important. And let's look at some, actually one more point, and then we look at some examples. As I've alluded to earlier, it's important to understand the difference between market rate and coupon rate. The coupon rate is simply stated on the bond, so it might be a number like 10%. Market rate is the rate that investors require from the issuer. So at the date of issuance, the market rate of interest may be equal to, less than, or greater than the coupon rate. If the market rate is equal to the coupon rate, the bond is a par bond. This means that the issue price, or the amount investors are willing to give the company for this bond, is equal to the par value. If the market rate of interest is greater than the coupon rate, the bond is a discount bond. So if the coupon rate is 10%, but investors want 12% from this company, given maybe because it has a low credit rating, then the bond will be issued at a discount. So for say 100 value par bond, the company might only raise 95. On the other hand, if the market rate is less than the coupon rate, so the investors are willing to live with 8% interest rate for this issuer. This means that the credit rating is very good relative to the coupon rate. Then the bond is a premium bond, which means that it is priced above par. So the company might actually say raise $105 for a $100 par bond. For bonds issued at par, and this is being repeated over and over, so just make sure you understand this, the market rate of interest at issuance, say 10%, is equal to the coupon rate, which is 10%. The present value of the cash flow then will be equal to par value. So the way you can think of this is, let's go back to the $100 par bond, and let's say we are taking a annual pay bond. So if the face value, or let's say the face value is 100, the coupon rate is 10%, and say this is a 3-year bond, then the cash flow for this bond times 0 times 1 times 2 times 3, cash flow is 10, 10, 10. These are the 3 coupon payments plus the face value at the end. So if the market rate of interest is also 10%, notice that the present value of all these cash flows will be equal to 100, which is the par value. And if you are unclear about what I'm saying, do this calculation, figure out the present value of this cash flow, and you will notice that that is equal to the par value of 100. So what is the entry in the balance sheet? When you issue this bond, you create an asset and a liability. So asset is the cash that you receive, so cash will go up by 100, and the liability is the bond payable, which will also go up by 100. Every year the interest expense is simply equal to the coupon interest paid. So the interest expense is going to be the 10% market rate of interest at issuance multiplied by the initial book value, which is 100. So the market rate of interest is 10, which is the same as the coupon rate. On the cash flow statement, the issue proceeds and final repayment are shown as cash flow from financing, and coupon payments are typically shown as part of the CFO. Bond issued at a discount. In this case, the coupon rate is less than the market rate of interest. The proceeds received will be less than the face value due to lower coupon rate. On the balance sheet, the discount bond will be recorded less than fair value, or less than face value. As the discount is amortized, the book value of the bond liability will increase until it reaches face value at maturity. On the income statement, the interest expense is greater than the coupon payment. The difference between the market rate and the coupon rate is the amortization of the discount. Amortization of the discount is added to the bond liability on the balance sheet. So as the bond liability increases, the interest expense will increase. Now I know that this might have been a little hard to follow, but let's look at this example which will make the matter clear. So let's say that on December 31st, 2010, a company, so let's say company IFT, issued a 3-year 10% annual coupon bond with a face value of 100, and we want to calculate the book value of the bond at the end of 2011, 2012 and 2013, and we also want the expense for each one of these years. So let's look at the cash flow on this bond. It's a $100 face value and 10% annual coupon. So how much money do we raise initially? What's the issue price? To do this, first let's just make the cash flow statement 0, 1, or the timeline. So the cash flow is 10, 10, 10. These are the coupon payments plus the $100 face value at the end. We need to discount this at the market rate of interest, which is 11%. So the market, even though the coupon rate is 10%, so coupon rate is 10%, but the market rate is 11%. So this means investors are demanding a rate higher than 10% from this issuer. So as you've seen earlier, this means we are going to have a discount bond. So get out your financial calculators and compute the present value of these cash flows. What you should get is this number 97 0.556. So this is the present value. Your accounting entry at time t equal to 0 would be that your cash goes up by this amount and your bond payable goes up by this amount. So you've created the asset and a liability at the beginning. The interest expense for year 1 is calculated by multiplying the initial book value that means the book value at the start of the period, by the market rate of interest, 11%. That gives you a interest expense of 10.731. The coupon payment is 10. So this is the actual cash flow. This is the actual money that you pay the bondholders. This is the expense that is shown on the income statement. And notice that since the par value is 100 and we only raised 97.556, this means that effectively we must be paying an interest greater than 10%, and that is the 11% interest. So this is what you show on the income statement. Now, what is the book value of this bond payable at the end of the year? And that value is 98.287. How did we get this? The way we get this is we look at the difference between the interest expense and the coupon. So interest expense is 10.731, the coupon payment is 10.000, so the difference is 0.731. This amount is added to the book value at the start of the year. So we have 97.556 plus 0.731 will give us 98.287. This is the book value of the bond at the end of year 1, which then carries forward to the start of year 2. So start of year 2 we have a book value of 98.287. Interest expense in year 2 would be 98.287 multiplied by 11%, which gives us 10.812. The coupon payment again is 10, and the ending book value is the difference between 10.812 and 10. So the difference is 0.812. Add 0.812 with the beginning book value and you get the end book value for year 2. This becomes the starting book value for year 3. The interest again is this number multiplied by 11%. The difference 0.9 between these two numbers is added to the beginning book value and you have the ending book value of 100. So notice that at the end of year 3 our bond value or the liability due has worked its way up to 100, which is the amount that is due at the end of year 3 anyway. So through this method, which is referred to as the effective interest rate method, we have amortized the bond liability from 97.556 all the way up to 100.000. So this is an important example. Make sure that you pause here and you understand this. So now let's talk about how to account for a bond issued at a premium. And again, I will read this slide, so try to follow the best you can, and then you will understand this well when we do the example on the next slide. So with a bond issued at a premium, the coupon rate is more than the market rate of interest. So we might have a situation where a bond's coupon rate is 10%, but the market rate of interest, which is the rate that the investors demand for this particular issuer, might be say 9%. This would happen because typically the market for this particular issuer has a very high opinion, credit rating is good, so people are willing to lend money to this issuer at 9%. The proceeds will be more than the face value due to a higher coupon rate. So the way you can think of this is, let's say face value is 100, the proceeds will be greater than 100. On the balance sheet, the premium bond will be recorded more than face value. So let's say if the proceeds are 105, then on the balance sheet we will record cash equal to 105 because that's what we've received. And also the bond payable liability will be recorded at 105. And then over time, the premium is amortized. The book value of the liability will ultimately decrease until it reaches its, actually we should say, par value at maturity. On the income statement, the interest expense will be less than the coupon payment. The difference between the market rate and the coupon rate will be the amortization of premium, and we'll see this on the next slide. The amortization of premium is subtracted from the bond liability on the balance sheet. As the bond liability will decrease, the interest expense will also decrease and reduce periodic amortization of the remaining premium. So if you didn't exactly understand that, no problem, but you need to understand this example. So on December 31st, 2010, IFT issues a 3-year 10% annual coupon bond with a face value of 100. Calculate the book value of the bond at year end 2011, 2012, 2013 and the interest expense for these years, assuming the bond was issued at a market interest rate of 9%. So the coupon rate is 10%. To make our example easy, we are simply dealing with annual coupons. And the market loves this issuer IFT, so the market is willing to accept a rate of 9% from this issuer. So what is the initial book value for this bond? So if you look at the cash flow over 3 years, the cash flow is 10, so that's your first coupon, 10% of 100, that's your second coupon, and then 10, your third coupon, plus the par value or the face value at the end. And the present value using an interest rate of 9% is 102.531. So on your calculator, if you plug in payments 10, n is equal to 3, FV is equal to 100, you will get this present value. So your initial entry at the start of 2011 would be that your proceeds, which is cash, goes up by this amount and your bond payable goes up by 102.531. Your interest expense is the initial value of the liability multiplied by the market interest rate at the time the bond was issued, 9%, and your interest expense for the year is 9.228. This is what goes on the income statement. The coupon is the actual cash flow payment that you make, and for US GAAP and at times with IFRS, this is a cash flow from operations, though IFRS might also allow you to categorize this as a financing cash flow. The end book value now is derived by taking the difference between the coupon. So we look at 10 minus the interest expense. This difference is subtracted from the book value to give us 101.759. This is the ending book value for 2011, which becomes the beginning book value of our bond payable at on January 1st, 2012. Multiply this by 9% to give us the interest expense for 2012. This is the coupon payment. Again, the difference is subtracted from 101.759 to give us 100.917, which is the starting value of 2013. Again, multiplied by 9%. Notice that no matter what happens to the market rate after the issuance, we continue to use the market rate that was in effect when the bond was issued. That is a financial reporting requirement. And in the end, following this procedure, we end up with a bond payable of 100.000. at the end of year 3, which is equal to the face value that needs to be paid back to the bondholder. The cash flow treatment, the coupon payment in our previous example, the coupon payment of 10 every year is an actual cash flow. For discount and premium bonds, the interest expense and the cash flow is not the same. The money that is paid out under US GAAP is always categorized in CFO. So the cash flow of 10 reduces the CFO because it is money out. The interest expense according to IFRS can be categorized in cash flow from operations or cash flow from financing. The initial proceeds as well as the final maturity where the par value is paid back to the investor will always go under CFF. Zero coupon bonds. So these are bonds which make no periodic interest payments. They are also called pure discount bonds. They are always issued at a discount from their par value. The actual interest is included in the face value, which is paid at maturity, and the effect on financial statements are similar to a discount bond, at least qualitatively speaking. Let me give you a simple example of this. Let's say that a company issues a 3-year zero coupon bond. So let's say that for this 3-year zero coupon bond, the face value, so this is time 0, this is time 3, the face value is equal to say 1000, and let's say that the issue price is equal to 900. This means that the company is borrowing 900 and the face value of 1000 is how much it will pay back after 3 years. It's not making any payments in between. So in terms of cash flows for year 1, year 2, year 3, there are no cash flows, but this does not mean that there is no interest expense. The way this will be treated on the balance sheet is initially we will say that bond payable, which is a liability, goes up by 900 and the cash, which is an asset, goes up by 900, and then we figure out what is the interest expense. So the interest expense is based on this 100 and 900. We calculate the effective interest rate and we multiply that effective interest rate by 900. So let's say that the effective interest rate is R%. So R% multiplied by 900 will give us our interest expense. So that's our interest expense that will go on the income statement. Note that the interest expense on the income statement is a non-cash expense. And when we amortize, we are basically going to add to the initial book value the difference between the interest expense and the coupon payment, which is 0. So over years, the bond payable will be amortized all the way up to 1000. So the logic followed is exactly what we did with our discount bond earlier. The subtle difference is that the coupon payment during the years is 0. So you can go back to the earlier example, plug in a coupon of 0 and solve this problem. So your assignment is to figure out the effective interest rate and to complete the amortization table for this zero coupon bond. Issuance costs. Costs such as printing, legal fees, commissions, and other types of charges are incurred when bonds are issued, and these costs are referred to as issuance costs. IFRS says that you must reduce the bond liability by the amount of the issuance cost, and this increases the effective interest rate. So the way you can see, or a simple example, let's say that for a bond that has a issue price equal to par value, and let's say that the issue price is 1000, but the issuance costs in this example are say $10. So in IFRS, according to IFRS, we will say that the initial value of the bond payable is equal to 990. So we record the liability as the net proceeds. Net proceeds being these proceeds from the issuance minus the issuance costs. So this, as you will notice with a discount bond, increases the effective interest rate. US GAAP says that firms can capitalize issuance cost as an asset, which is essentially a prepaid expense, and this is amortized over the life of the bond. Amortization methods. IFRS requires us to use the effective interest rate method, where the interest expense is equal to the book value at the start of the period multiplied by the market rate of interest at issuance. And this is exactly what we have done all along in our examples as well as in our explanation, and this is what you must know. US GAAP also allows companies to use what's called the straight line method, and very simply put, this is how the straight line method works. Let's say that the proceeds from issuance are equal to 900, and let's say that the face value is equal to 100 or 1000, and this bond needs to be amortized over 3 years. So what the straight line method does is looks at the difference between the two, which is 100, and it allows you to amortize an equal amount every year. So that's why this is called the straight line method. So the amortization will be 33.33 here, 33.3 in the next year, and 33.3 in the third year. So we basically work our way up from 900 to 1000. Not a hugely important point though. Derecognition of debt. Firms can redeem bonds before maturity. We'll see this in a lot more detail when we do fixed income securities, but the idea is this. Let's say a firm has issued a 10-year bond, and after 5 years the firm wants to redeem the bonds. So assuming that this is allowed based on the bond indenture, the firm can pay investors an agreed upon sum of money and essentially redeem the bond. So the investor gives the bond back to the firm gives money to the investor, and the bond has been derecognized. This might happen when interest rates have fallen, or the firm has generated surplus cash through operations, or funds from the issuance of equity make this possible. So there can be a host of reasons. Gains and losses are recognized for bonds redeemed before maturity. So let's say that we continue with this example. 5 years into the life of the bond, let's say that you redeem the bond for 105, and the book value of the bond is, let's say, 100. So you have paid more for the bond than the book value. So this difference of 5, so you've paid 5 with 105, which is the redemption, minus the book value of the liability is 100. So what is going to happen here is you are going to record a loss of 5 in the, so in this case this is actually the loss that you are going to record. So another example, if the redemption price is 1,020,000 and the book value is 995,000, then you record a loss of 1.02 million minus 0.995 million, which is a loss of 25,000. So the logic is straightforward. If you pay more than the liability, then your cash, so the accounting entry here will be as follows. When you pay this much, your cash goes down by 1.02, so this is 1.02 million. The book value, so your bond liability or your bond payable goes down by this much. So these two don't balance, and essentially then your equity is going down by 25,000. So loss of 25,000 means your equity is going down. So that makes the decrease in assets equal to the decrease in liability and equity. Under US GAAP, unamortized bond issuance costs must be written off and included in gain-loss calculations. So if you recall from the earlier slide, any issuance costs were capitalized. So essentially we created an asset and amortized that asset. Any unamortized part of that asset must be written off and included in gain-loss calculation. So it will actually be a loss. With IFRS, recall that we did not create any asset because we simply reduced the value of the bond liability, and hence no write-offs necessary. The gain or loss from extinguishing debt is reported in the income statement in a separate line item whenever the amount is material. Debt covenants. So these are restrictions on the issuer that protect the bondholder's interest, and they help reduce default risk and also decrease the cost of issuing bonds. We will see this in much more detail in fixed income securities, but we can have either affirmative covenants or negative covenants. Affirmative covenants are where the company, the issuer, makes statements that we will do so and so. So for example, the company might make a statement that we will maintain a interest coverage ratio of greater than 5. Negative covenants are where the firm says that we will not do so and so. As an example, the company might say that we will not issue any more debt that is senior to this debt. A technical default happens where the issuer is still making its coupon payments but violates one of these covenants. So that is called a technical default. The final point now on bonds related to presentation and disclosure. Firms usually combine their long-term debt outstanding into one line on the balance sheet. The portion of liability due within 1 year is shown as a current liability. So anytime you look at a balance sheet of a company that has some debt, you will see in the current liability section a subheading that says current portion of long-term debt. So that refers to this point over here. We need detailed footnotes associated with this line item on long-term debt. This needs to talk about the nature of the liabilities, maturity dates, stated and effective rates, any call provisions or conversion privileges. We'll understand this better in fixed income securities when we study this in a few weeks. Any restrictions imposed by creditors, any assets pledged as security, and the amount of debt maturing in the next 5 years. And both qualitative and quantitative discussion of firms' long-term liabilities is also found in the management discussion and analysis section. So that's it. In the next segment, we are going to talk about leases.